Oh boy, are we excited. Why? Because you've studied quite diligently and thoroughly the previous chapter on the introduction to stocks, right? Yes, because now, dear students, we've got a treat for you. We're going to take our first steps towards valuing stocks. Yes, we're going to look at a few valuation models because value matters. You ignore value at your peril. Now, this was said by a gentleman who at the time had over 35 years of experience as a mutual fund manager. He's since retired, but still, very successful career. And after 35 years, you think you know what he was talking about, right? And then we'll steal from Sir Arthur Conan Doyle, whose character Sherlock Holmes said, "It is a capital mistake to theorize before one has data." Yeah, pretty smart cookie, that Sherlock Holmes. So let's get started. We're going to embark upon the process of stock valuation. Stock valuation is the process by which the underlying value of a stock is established on the basis of its forecasted risk and return performance, or results, or rewards, whichever term you want to use. At any given time, the price of a share of common stock depends upon investors' expectations about the future behavior of the security, of the company, of the business. A fundamental assertion of finance holds that the value of a stock is based on the present value of its future cash flows. Now, a corporation, a business, a company, the future cash flows are its earnings or its dividends or both, depending on what you are going to key on. So the worth of a company is primarily based on the earnings the company will produce in the future. But if we knew what was going to happen in the future, we wouldn't call it the future, would we? Yes. Here's the wisdom of Professor Burton Malkiel, who wrote A Random Walk Down Wall Street, one of the books that you're eventually going to read sooner than later, I hope. The other one is One Up on Wall Street, yes. And then eventually The Intelligent Investor. But don't do that one first. Do either A Random Walk Down Wall Street or One Up on Wall Street first. And he stated in his book, A Random Walk Down Wall Street, the most fundamental influence on stock prices is the level and duration of the future growth of earnings and dividends. However, future earnings growth is not easily estimated, even by market professionals. So just because they're a stockbroker or a mutual fund manager or a pension fund manager professionally in the industry doesn't mean that they know what's going to happen in the future either. So if someone were to ask you very succinctly, what is the most important factor in determining the future value of a company? In a few words, you could say future earnings, or you could say future dividends, depending on what you key on. Some people might even say future cash flow, and we'll deal with that later. But do any of us know what's going to happen in the future? No. So is valuing stock going to be easy? No, it's not easy. If it were easy, yes, we'd all be fabulously wealthy. And it just doesn't work that way, does it? No. So we're going to take a look at a process called security analysis. It's the process of gathering and organizing information and then using that to determine the value of a share of a common stock. And we're looking for what's called the intrinsic value. What is it worth? The underlying or inherent value of a stock as determined through the security analysis. Okay, the question then becomes, what security analysis methods or measure does one use to determine the intrinsic value of a company? Do we use future earnings, future dividends, potential capital appreciation? Do we use the price-earnings ratio, the financial ratios, the past price performance, the amount of risk? Value is in the eye of the beholder. And of course, some of us are going to use certain methods and others are going to use different methods, and everybody has a different idea of what they want from the stock. So obviously you can see that this is an area of much contention, much dissension, no one consensus. And we're going to show you a few models, but there are many more, and you're going to have the rest of your investing career to study and seek them out and decide which ones work best for you. We are going to use what is called fundamental analysis. Fundamental analysis is the examination of a firm's accounting statements and other financial and economic information to assess the economic value of a company's stock. Doesn't that make sense? Yeah. Some of the examples of the fundamentals are the competitive position of the company. Is it Coca-Cola or Pepsi-Cola or RC Cola, or maybe it's Monster? What are the growth prospects for the company and its market and its products? What are the profit margins, the company's earnings? What assets are available? The company's capital structure, which is a fancy term for how much debt do they have, how much of the company do they own, how much equity. Simply put, the value of a stock is influenced by the performance of the company that issued the stock. The fundamental analyst says you are buying companies, not stocks. Now, to me, this makes perfect sense. I mean, this is what I do. This is what I try to do anyway. We're all trying to do it. No one's, well, it's like few people are very good at it, and most of us are going to be marginally okay, and that's good enough to build wealth slowly unless the world ends. But there's an entirely different form of analysis called technical analysis, where they throw out all this. Basically, we can sum it up in saying that we look at squiggles on a screen and try to determine what's going to happen in the future. And the technical analyst says you are buying stocks, not companies. Don't worry, we'll get into technical analysis later on. But suffice to say that I'm already going to tell you my biases up front so that you understand, where I'm coming from, and then you'll see, oh, this other person, he loves or she loves technical analysis. I think they're all wet, personally, but hey, that's why there's chocolate and vanilla, and some people like strawberry. And we'll look at the strawberry too. So are you excited? Are you ready? Because when we come back, dear students, oh my goodness, we are going to be introduced to a powerful valuation model that most people who pick and buy stocks and sell stocks, they don't even know these things exist. So you are going to be introduced to the sacred wisdom that is embedded in the ancient art of dividend discount models. Yeah, I know, I get really excited about this. And I hope you do too. So we'll see you in our next presentation, dear students. Dividend discount models.